Hi, this video is going to include additional information for you to study in conjunction with your full Series 65 or Series 66 course. I designed this video to cover topics that were either lightly covered in the original videos or have not yet been covered at all. Remember, this video is not to view all by itself, but in conjunction with your entire course. This video will not have any exam-specific questions directly related to this content. Just some things that you will want to know that I expect you might encounter on your test. Whether or not they're questions that actually count in your final score or they are in fact pre-test questions, we never know, but I want to make sure to provide you with all of the content that you will need to feel comfortable in taking your exam and passing on your first attempt. Let's get started. Remember on your test to always go with what you know. If you have to guess, pick the longest answer. Now, I didn't say always pick the longest answer. I just said if you have to guess, then go ahead and pick the longest answer. But do your best to, by process of elimination, get rid of some of your choices. Remember, with your test, the questions are going to be very long, very wordy. It's hard for me to make up questions that are as long and as wordy as you're going to find on your real test. But this is what I've heard from students. When they first see a question, sometimes it looks like just overwhelming, but what they've done, what they've found to be very successful for them, if it's a long and wordy question, is read it twice. And then once you do that, you actually can see what the gist of the question is, and it's not nearly as hard as you thought it was going to be upon first glance. So if time allows, if you're someone that doesn't seem to run out of time, go ahead and read the longer questions twice, then read all 4 of your choices, and then of course, as always, pick the best answer. Don't get bogged down in the law details. There is a lot of similarities between state and federal law. If all else fails and you can't remember if they're same or they're different, just pick that they're the same. Most of the time, state and federal laws are the same. Today, this is not a math test. I would say for your 66 exam, you can expect 0 to 2 math questions, and for your 65 exam, 2 to 4. So the test just kind of changes over time. Where historically it used to be a math-heavy exam, it is not currently a math-heavy exam. It is much more conceptual these days. Don't forget, your test has 10 extra questions. They will give you 10 additional minutes as far as your testing time goes. Which 10 don't count, you don't know. I had a student once tell me he thought they were the last 10 questions, so he blew those off. He passed, thank goodness. But they are not the last 10 questions. So they're mixed in throughout your test. Answer everything like it counts. Those that don't count, if you get them right, it won't help you. If you get them wrong, it won't hurt you. But answer everything like it does count. Generally speaking, the test is written to start off easy in the beginning, it's hard in the middle, and then get easy again at the end. So that is normal. However, I know every once in a while somebody swears their whole test was hard, which is sometimes how it feels. But you can do this. I promise to provide you all the tools you need to pass this test. So additional content, I've grouped these additional items by section so that you know, depending upon which exam you're taking, 65 or 66, where the emphasis lies. So make sure you're always paying attention to the outline. For example, section 1 for 65 is a much heavier area than it is for one of my 66 students. Same information, but the number of questions that you get from section 1 is much heavier on your 65 exam. So section 1, economics and business information. Once again, this is not everything. This is just items that are new or students have found were hard, so I wanted to make sure to explain them again to you. Mean. Mean means average. The median is simply the middle number. Mode is the number that appears most frequently within a data set. It's highly possible you're going to see something like this on your test. 42, 46, 49, 50, 51, 52, 54. So we said mean is average, median is the middle, mode is the number that appears most often. So with those three definitions, what's 50? 50 is the median. It is the middle, right? 1, 2, 3, 1, 2, 3. 50 is the median, the middle of these numbers. M1. So these have been known to appear on the test recently. So when we're talking about the money supply, M1 is a very liquid measurement of the money supply. It includes all physical money, such as currency and coins, as well as demand deposits. That includes checking accounts and negotiable order of withdrawal accounts. M1. M2 includes all of M1 plus time-related deposits, savings deposits, and non-institutional money market funds. The inflation-adjusted level of M2 is a leading economic indicator. The inflation-adjusted M2. So we sometimes call M2 the money supply. Is a leading economic indicator. M2 is used by economists when looking to quantify the amount of money in circulation. Thus, we call it money supply. It is also used to forecast inflation. So the Federal Reserve controls monetary policy, and Congress uses fiscal policy. So when we're trying to influence the economy as a whole, that's called macroeconomic action. Changes in an individual's tax code is microeconomic. So microeconomic actions affect individual taxpayers, where macroeconomic actions affect the economy as a whole. So purchasing U.S. government bonds or selling U.S. government bonds, those are two things that the Federal Reserve Board can choose to do. Those are macroeconomic. Macroeconomic actions also include when the Federal Reserve changes interest rates, changes reserve requirements as well. So the buying or selling of U.S. government securities, the raising or lowering of interest rates, and the changing of reserve requirements, all of those. Monetary policy set by the Federal Reserve, macroeconomic actions. Some stocks are cyclical. A cyclical stock is one that moves with the market cycle. So we know the four phases of the business cycle: expansion, peak, contraction, trough. So certain types of segments of the economy do well depending upon what market cycle we're in. So if we're in an expansion, more people will buy new cars than if we're in a contraction. So generally speaking, automotive stock is cyclical. We'll do better in expansions. Cyclical stocks rise and fall with the cycles. They tend to be stocks of companies that rely upon consumers' discretionary spending. So I said already, automobile stocks, cyclical. Also airlines, we're more likely to take a vacation, actually fly to take our vacation when the economy is doing well. Hotels and restaurants, those are all cyclical stocks. So go up when the economy is expanding. Counter-cyclical stocks will move in an inverse direction related to our phase in the business cycle, moving up in a down market and vice versa. Counter-cyclical stocks are stocks of companies that no matter what, people will still spend money on. For example, utilities, groceries, and gas. So those tend to be counter-cyclical stocks. doing better during economic contractions. The test loves, I know I've said this before, but they love the defining characteristic of a value stock. Now remember, when they use the term value stock, they mean a stock that represents a good buy. So they mean a stock that is undervalued relative to financials. Undervalued relative to financial analysis. The defining characteristic of a value stock is it has low price-book ratio. So the book value of the stock comes from the company's balance sheet. So the book value is actually found within shareholders' equity on the balance sheet. So this is a stock that, relative to the industry, is trading at a price-book value that's much lower than you would expect it to be. So it's a good buy. It's an undervalued stock. So value stock has low price book. They love that. What's growth stock going to have? High or low price earnings ratios? High. So this is a review, but these are things that students just, want to be reminded of, generally speaking. Growth stocks have high price earnings ratios. They also have high price book ratios and high beta. So remember, the beta factor measures the stock's volatility compared to the S&P 500, or the market as a whole. So high beta is higher risk. The capital asset pricing model is based upon the work of Jack Traynor, William Sharpe, John Littner, and Jan Mawson in 1962. It built on the earlier diversification and modern portfolio theory work of Harry Markowitz. It is the capital asset pricing model that is used to determine the required rate of return of an asset if it is going to be added to an already diversified portfolio, given that specific asset's non-diversifiable risk. So this emphasis on capital market theory, the capital asset pricing model. The capital asset pricing model. The capital asset pricing model will consider that asset's sensitivity to market risk, systematic risk. We know market risk is a type of risk that is systematic. It's non-diversifiable, commonly called the stock's beta factor. This model also looks at the expected return of the market as well as the expected return of a risk-free asset. So the risk-free return is the rate of return on Treasury bills. The capital asset pricing model is used to determine expected return. You may see reference to what's called the capital market line. So the capital market line is used within the capital asset pricing model. So the capital market line is a line used in the capital asset pricing model to illustrate the rates of return for efficient portfolios, depending upon the risk-free rate of return and the level of risk standard deviation of the portfolio. So the capital market line is used to determine what would happen if you added this specific security to the portfolio, the capital market line. You can also use the capital asset pricing model to determine if an investment is over or undervalued relative to the market as a whole. For example, if the beta is 1 and the investment has a 10% return, so the question might give you a given. So this is a given. So if a security or a portfolio's beta is 1, if then the expected return is 10%. Okay, so that is given in a question. So it might have said if the if the beta is 1, the expected return is 20, or whatever it says. This is just an example to show you sometimes what they'll do on the test. So if the beta is 1, then the expected return is 10%, and then it wants you to determine which of these would be overvalued. And this is a strange way to say it. I don't know that I would exactly say it out in the real world the same way, but for the test, this is perfectly fine. So when the beta is 1 and the expected return is 10%, what we're basically saying is for every 1/10 of beta that you take on, you can expect to earn 1%. For every 1/10 of beta you take on, you can expect to earn 1%. So we would expect if the beta was 2, the expected return would be what? Double? 20%? So based upon the assumption of a beta of 1 can expect to earn 10%, they're going to give you scenarios. So if you take on a beta, so a stock or a portfolio beta of 1.5, what can you expect to earn based upon our discussion? 15%, yes? So it says the return of what you selected that had a beta of 1.5 was 17%. So when the actual return is greater than what the capital asset pricing model predicted, so the predicted return was 15%. So what that means, you earned more than what was predicted. That, for the purposes of the test, means that this is undervalued. Undervalued. What if you chose a stock with a beta of 1.3? What's the expected return based upon our assumptions? 13%. And the actual return was 15%. Over or undervalued? Once again, undervalued. If you chose a stock that had a beta of 2 and the actual return was 18, now what? What did we say? We said if the beta was 2, we can expect to earn 20%, so the actual earnings were only 18. This is overvalued. Overvalued. What if you chose a stock that had a beta of 2.4 and an actual return of 22%? What would you expect if it was 2.4? The actual earnings would be 24%. Once again, overvalued. So if the actual return is less than the expected return predicted by the capital asset pricing model, then that investment, that security, that portfolio is overvalued. Now, we can tie together into this discussion what is called alpha. Alpha is the return that is in excess of the return predicted by the capital asset pricing model, or an equilibrium model. So in this story here, we said we expected, based upon the capital asset pricing model, assumptions that we discussed, to earn 15%, but we earned 17%. This is this investment's alpha. This is the excess earnings. So if you earn more than what was predicted by the capital asset pricing model, that is alpha. If the expected return is 12% with a beta of 1, then the alpha would be whatever is in excess of the 12%, whatever the prediction is. If you choose, so once again, because this is kind of a funny concept, if you choose a security and it does better than what the given is, So in one question, the given might be beta of 1, expected return 10. In this question, the beta of 1, the expected return is 12. So if you choose a security with a beta of 1 and you earn 17, 5% is that security's alpha, whatever is in excess of what the capital asset pricing model predicted. If beta is 1, the earnings are 7. So once again, that's a given. If you were to take on an investment with a beta of 3, what could you expect it to earn? 3 times 7, 21%. If the investment earned more than that, it would be underpriced. It would have an alpha. If the investment earned less, then it would be overvalued. The risk premium is the rate of return on an investment that is in excess of the risk-free return. The rate of return on a treasury bill is the risk-free return. It is the T-bill return that is used for risk adjustments. Along with the capital asset pricing model, the test loves efficient market hypothesis, which we did cover in the other parts of this course, but I just want to make sure again. They love this whole theory, the idea that everything to be known is already known, nobody can beat the market. It presents itself in 3 forms: weak, semi-strong, and strong. So you have got to know the 3. There is no such thing as a semi-weak. Nobody walks around saying, I'm semi-weak, right? You might say you're semi-strong, but you never say you're semi-weak. So there's 3, and anytime there's 3, they love to ask except questions. So just to review, because like I said, they just love this on the test. I would expect 1 or 3 questions on the test about this. With the weak form of the efficient market hypothesis, it basically says the only way to win is through fundamental analysis. So it says no quantitative analysis, but fundamental analysis may work. So weak, no technical, but fundamental analysis may provide excess returns. Semi-strong says no technical, no fundamental. It says no trading on public information. No excess return can be made by trading on public information. No public information. So companies have to do that 8K filing with the SEC within 4 business days of a significant business event to disseminate that information broadly. So people go out there and trade based upon this public information. The semi-strong form of the efficient markets hypothesis would say that's not going to work. The only way to win in the semi-strong form is through insider trading. Now, I did not say go do insider trading. You cannot. That is prohibited, not allowed. You'll get in big, big trouble if you get caught. But the test likes this idea. Which form of the efficient markets hypothesis does insider trading provide excess profits? In the semi-strong form. So in the strongest form, it says no to everything. No technical, no fundamental. It says no public and no inside. Another way of saying the same thing is that what form believes that the market price is already reflective of inside information? That's the strong form of the efficient markets hypothesis. So you cannot, not even an insider, can provide excess returns by trading on inside information. You might as well just build a broadly diversified portfolio and hold on for the ride. That's the theory. It's not is it right or is it wrong, it's just what's the theory. The test likes you to know that. So during a highly efficient trading market, the best thing you could do would be to build that diversified portfolio, maybe buy an index fund. Hold on for the ride. The efficient markets hypothesis says you cannot time the market. The markets are efficient. Everything to be known is already accounted for in the stock prices. An exchange rate. The exchange rate between 2 currencies is the rate at which one currency will be exchanged for another. So it could be dollars to yen, yen to euro, euros to pounds. It's not just from the point of view of American dollars. Exchange rates are determined in the Forex marketplace, so the foreign exchange market. The spot exchange rate is the current exchange rate. So my oldest boy just recently went to Europe, and I gave him basically what amounted to $40 a day. So I said, here's your $40 a day. And he looked at me and he said, Mom, you do realize that will not get me 40 pounds a day because the dollar is currently weak. So for his $40, he got much less pounds. Same thing with euros. $40 wouldn't get him 40 euros, it would get him less euros. Because the exchange between the dollar and the pound currently and the dollar and the euro is, the dollar is weak. Both the euro and the pound are currently stronger than the dollar is. Currencies trade in pairs in the Forex marketplace. You could trade, like I said, dollars for euros, euros for pounds, yens for pounds. Their pairs are many. So we said the current exchange rate, we call that the spot, like on the spot exchange rate. The forward exchange rate is an exchange rate that is quoted and traded today, but for delivery and payment on a later date. So forward contracts to exchange currencies in the future. So we predetermine the price now, and we do the exchanging in the future. We talked about the exchange rate tells you how your currency will exchange into another. Today, $1 converts into 0.81 euro. If you had 1 euro, how many dollars would you get? If you had 1 euro, more or less US dollars today. If you had 1 euro, you get more US dollars, so $1.23. The dollar is currently weaker than the euro. Generally, during a protracted economic downturn, the strength of the dollar weakens. So during an economic downturn, the strength of the dollar weakens against foreign currencies. Historically, the US dollar has strengthened after a protracted economic downturn, such as the Great Depression and Great Recession. So after the Great Recession, the dollar has strengthened. It's still not stronger than many foreign currencies, but it's not as weak as it was during the Great Recession. Publicly traded companies are required to file their financial information with the SEC through what's called the Edgar system. So the 8K, I just said that earlier, is due within 4 business days of a significant event. 10Qs are unaudited financial statements that are due quarterly. There's 4 quarters in a year, but there's only 3 10Q filings because there's one 10K, which is the annual audited financials for public companies. So I was looking up something the other day, and the Edgar system, it's pretty easy to use. They're working on making it more user-friendly as we go. But anything you ever wanted to know about the finances of a publicly traded company are available through this system. So 8K within 4 business days, 10Q quarterly, 3 times a year, so be careful there, and 10K annually audited financials. As a mutual fund shareholder, you get 2 reports from the mutual fund company every year. An annual report, which has audited financial data, and a semi-annual report, which has unaudited financials. In these mutual fund shareholder reports, the mutual fund is allowed to include what's called a summary portfolio schedule. So if you think about it as a mutual fund shareholder, within your annual and semi-annual report, they're not going to tell you within the portfolio every single stock that they own. I mean, think of how many different companies that they own, right, within the portfolio. There'd be too many. So they can include within your annual and semi-annual report what's called a summary portfolio statement. Summary portfolio statement. That's perfectly fine. Where, depending upon how big the portfolio is and the size, what company A stock represents to the whole. They've basically got to tell you what their largest holdings are. Summary portfolio schedules may be given to clients, must be given to clients. How often? Twice a year. They're included within the annual and semi-annual report. A registered management company, which is a type of an investment company, must include a tabular or graphic presentation of its portfolio holdings in its reports to shareholders. So not only do they have to list things, but they have to show you either graphically or tabularly what it looks like, so in a more visual manner. A registered management investment company is required to disclose its complete portfolio schedule on a quarterly basis in filings with the Securities and Exchange Commission that will be certified by the company's principal executive and financial officers and available on the Commission's EDGAR system. Somebody recently asked me, what did EDGAR stand for? I never had anybody ask me, but this is what it stands for: Electronic Data Gathering, Analysis, and Retrieval System. So they have to disclose their entire holdings, detailed holdings, every quarter. So 3 quarterly reports, 1 annual report, 10 Qs, 1 10K, and summary portfolio schedules to the shareholders twice a year. The investment company's complete schedule, filed with the SEC, must be provided to the shareholders upon request, free of charge. A registered open-end management investment company must include in its shareholder reports disclosure of fund expenses borne by shareholders during the reporting period. That's interesting. So all of the expenses that the shareholders actually pay for must be disclosed. That seems fair. A registered open-end management investment company must include within the annual report the management's discussion of fund performance. Those are always letters that you find at the beginning of the annual report. I find them very interesting. If you're weird like me, you should go read some. I do actually really enjoy reading them. The Securities Exchange Act of 1934, we call that sometimes the People Act. The Securities Exchange Act of 34. So the People Act. The Securities Exchange Act of 1934 requires the registration of securities information processors. Securities. So we live in the digital age where there's so much information. So this is, I guess, relevant to your test. Something that historically has not really appeared, but maybe you might see it. Securities information processors file a form with the SEC called Form SIP. The consolidated tape displays past transactions for listed securities. So you've seen, if you watch financial news along the bottom, the historical transactions, what's occurred on the floor of the exchange, what's occurred in the NASDAQ stock market. The consolidated tape display is maintained by the Consolidated Tape Authority. So the consolidated, so there's all this data. The Consolidated Tape Authority is responsible for that last trade data. So we call them sometimes the CTA. The CTA is a securities information processor, a securities information processor. So by definition, within the Securities Exchange Act of 34, the definition of securities information processor includes any person engaged in the business of 1, collecting, processing, or preparing for distribution or publication, or assisting, participating in, or coordinating the distribution or publication of information with respect to transactions in or quotations for any security other than an exempted security. Or, secondly, it includes person engaged in the business of distributing or publishing, whether by means of a ticker tape, a communication network, a terminal display device, or otherwise, on a current and continuing basis, information with respect to such transactions or quotations. So it would make sense that the SEC would require registration for the people that are actually gathering the data and making it available to us, okay, making it available to the industry as a whole. The term SIP, Securities Information Processor, does not include any bona fide newspaper. It does not include a news magazine or a business or financial publication of general regular circulation. It doesn't include any SRO. It doesn't include a bank, broker, dealer, building and loan, savings and loan, or homestead association or cooperative bank. So the Consolidated Tape Authority is one of many securities information processors. Sovereign risk is a very specific type of risk that has to do with when your client purchases foreign government debt. So we've had over the past few years what we've called a sovereign debt crisis in Europe. Sovereign debt crisis. It's not that the companies publicly traded in Europe are going broke, it's that some of these European countries, so sovereign debt has to do with debt of a foreign government. That's when you have sovereign risk, when you purchase debt of a foreign government. So we had the Greek debt crisis. Spain was having some issues there for a while. Sovereign debt, the risk that the government that you purchase the debt from might default on their debt. Political risk would be related to elections. Political risk, one of the many types of political risks, is related to elections. So that's your review of some newer information for Section 1.